This is Steve Butler. I'm the CEO for C&IDocs, and I'll be your host today for our C&I webinar. First of all, I want to thank all of you for attending the webinar. You're all real busy people, and the time that you're giving us for this webinar is really greatly appreciated. What I'm going to do is, this webinar, of course, is going to be presented by Ren Hayhurst, who I'll describe shortly. But let me just talk a little bit about what you're going to hear today and a little bit about C&IDocs. All of you on today's webinar are long-term users of C&IDocs, and we really appreciate your continued support of the company. And you're using some or all of the products on this screen here. And I guess what I would say I've heard from all of you, and many of you anyway, and what I hear consistently from you is that, C&IDocs has great support, really high quality documents, very easy to use, a lot of accuracy, and always compliant. And we value those fundamental capabilities. We put them into all of our products. So any of the products up here have that foundation as part of it. And as we approach C&I, that's exactly what we're doing as well. Now, if you haven't used construction docs, we released that, and that is a very comprehensive solution for ground up construction, subdivision development, major rehab, all automated. And then also our loan modification product called C&IDocs, which provides you, of course, in this market, loan modifications are really important. And this provides you a rich set of easy mods to do at a very low cost. And so check out C&IDocs and construction docs. But this webinar today is about C&IDocs. And if you really like our CRE product, our commercial real estate product, you're really going to like C&IDocs, I think. So how do we approach it? First of all, we talk to a lot of customers, some of the ones that are on this webinar today, as well as a number of other customers. And what we found is a pretty big gap in the marketplace between what C&I automation solutions are out there, C&I doc automation is out there, and what it could be. And as you know, the way we approach commercial real estate is we basically want to automate everything. We want to even do the hard stuff, not just the easy stuff. But we have lenders today that document the $50 million, multifamily, big commercial properties. We automate the hard stuff as well as the easy stuff. And that's really the gap that we found in C&I. And that's the approach we took here, a very rich, comprehensive platform that brings along all the ease of use, the compliance, the accuracy, the easy integration, all of those things, the great support that you love about commercial real estate. We brought it over to C&I. So when you think about our product, think about a solution that can take you to the next generation in terms of what you automate. What we found today is there's still too many attorneys involved in doing C&I documentation. And so as a result, you pay more money, it's a lot slower. And the customer experience is not as what it could be. And so we took a different approach, and that's what you're going to hear about today from Ren Hayhurst. So let me talk about Ren a little bit before we go on to the webinar. So Ren is one of the most accomplished commercial lending attorneys in the country. He's been doing it for over 30 years. He was previously a senior partner in the commercial powerhouse finance group, powerhouse team, Brian K. Leitner and Paisner, which is an international firm. He built a significant practice there and across the entire U.S. and ran that for many, many years. And he took an early retirement, and we, of course, said, wow, why don't you come join us? And so he joined us and is involved in a number of he's really the visionary for a lot of our products, but in particular our C&I product, as he's done a lot of years of this. And so what you're going to hear from Ren is not just about where C&I has come from, but where it needs to go to really automate and protect lenders well, but also give them the margins that are possible from a high volume C&I business. So with that background, I'm going to turn it over to Ren and get right into this webinar. Ren?
Thank you, Steve. I appreciate that. It's a pleasure for me to be able to join all of you and spend a few moments here talking about business commercial financing, or otherwise known as C&I lending. And as Steve mentioned, our goal in trying to automate the documents was to think from the most complex and design towards that so that we can always pare down to the more direct, more easy to use, more maybe even borrower-friendly types of documents. But the strategy is always to provide the users with as many business options. And that's particularly valuable right now because we're in a time of somewhat uncertainty. I mean, we're seeing some positives with inflation. We're seeing some positives with maybe the Fed giving some indicators that they might be done here, maybe with one more bump in the Fed funds rate, but otherwise we may start to see, even as soon as the end of this year, or some prognosticators are saying the first of next year, rates start to ease back and start to come back down. Now, I don't think anybody is out there predicting we're going to see rates get into the crazy areas that they were to try to pull us out of the global recession. But certainly it's realistic, I think, to set ourselves up for a more positive rate environment in 2024 and really a much more robust economy in that year moving into 2025. So with that in mind, we wanted to be ahead of that curve and not only be able to design C&I documents for the good times, but also to work through the current times right now where there's still that uncertainty. And you have prognosticators saying the rates could even come down by the end of this year, to some saying, well, it won't come down until 2025. And that's going to change the dynamic. But I want to give you a little background on me and the kind of thinking the entire company has when we look at designing a product for a market like commercial and industrial. I started my career as a trial attorney. In the first 8 years, I came out of the collapse of the savings and loan institutions and worked through a lot of failed savings and loans, worked through some troubled bank situations. As the people who might remember that time period, the collapse of savings and loan led to a real serious recession in the real estate market and affected banks and credit unions and all types of lenders that were somewhat dependent, seriously dependent on their real estate investment portfolio. Commercial financing has always been part of the mix, and largely commercial financing and its strengths and its boom periods don't always tie in necessarily to what we see with real estate. So you can have a situation where maybe real estate is on shaky grounds, which it has been the last year, and it's been an area where banks are retreating from lending, where credit unions are tightening their underwriting, and you see private lenders picking up more and more of the market in the real estate area. C&I lending is a little bit different. That's always been historically the playground of the banks. And in fact, over the years, coming out of the global recession, we saw incredible growth in the C&I market. We saw 400% growth in total loans on the books. This is a $1.2 trillion industry. So it has really responded very quickly after the recession. And during the years 2012 to 2017, you saw really a consolidation amongst national banking associations who were making upwards of 70% of the entire C&I market, and as much as 35% of that was concentrated in the 4 major national banks. But this is still an area where community banks have large, important portfolios. And as everybody has retreated a bit on real estate, we have seen that notwithstanding the pandemic, and I'll talk a little bit about that in a second, and its effect on the market, but also coming out of the pandemic and having inflationary times, the demand for commercial loans has remained constant, and the amount of lending in the commercial space has not slowed down at anywhere near the rate that it has slowed down in the commercial real estate area. So what are some of the factors that brought us to this point? Well, we all know coming out of the recession, we had a very low interest rate market. We had a rebounding economy. And we did have lenders for the first 3-4 years of that post-recession cycle be very tentative in getting back and building up their real estate lending portfolios, particularly in things like construction loans. And so you saw the rise of a lot of private lenders filling that space. And in a way, the private lenders picking up that business and becoming more powerful players on a national platform, not just small niche lenders, but large, what you would call lending factories, large, powerful companies that were closing 500, 700, 1,000 loans a month, mainly in the residential to rent market, the 1 to 4 unit business loans, but also moving into multifamily and other areas. Interestingly, the banks really focused and building up their C&I portfolios during that same time period and decided that that is where they were going to put their investment dollars. By the time we got to about 2017, a phenomenon started to happen that is interesting to think about. One is you saw the rise in 2017, 2018 of delinquencies increasing as much as 400% over an 18-month period. Those delinquencies then turned into non-performing loans. And for a regulated lender like a bank or a credit union, a non-performing loan really is not something that is desirable or at all even tolerable. And there's regulatory pressure to clean up non-performing loans, whether that's exercising remedies, whether that's restructuring the credit. But what's interesting is, notwithstanding this increase in delinquencies and non-performing loans, the level of lending in the C&I market remained high, and in fact hit a fascinating peak during the midst of the pandemic. And 2021 was an all-time peak period in this country for commercial loans. Now, as you probably all realize, a big part of that is the result of the federal PPP program. And that certainly customers of banks who might not ordinarily be seeking business loans needed them at that time and availed themselves of that program. But that program was a success. It was a success for the borrowers who took advantage of it. And it has been a relative success for the banks who have made those loans. And so the level, although from 2021, the level has dropped back down, it's dropped back down to those 2017, 2018 levels. And so right now we find ourselves in a market where there's a high demand because of economic pressures on borrowers to find sources of capital, to smooth out their cash flow, to better balance immediate needs like new staffing or dealing with supply chain issues or the variety of pressures that are caused by an inflationary market and a market where people are slow to go back to work. And that is where commercial lending has continued to fill that gap. What we're going to do today is we're going to talk about 3 different basic subjects and spend a little time on each of these. We're going to talk about the broad range of borrowers that are seeking commercial loans. What's interesting is a lot of the delinquencies and non-performing loans, I think the reason it did not create any kind of a panic is that it was fairly concentrated in the energy sector and the retail sector. And so manufacturing, construction, a lot of other businesses in this country that aren't retail or aren't dependent on the energy sector really were doing quite well and were able to successfully be successful borrowers. under a commercial loan program. But we started to see also post 2017 the rise in more startup businesses, more small businesses. In the gig economy that we're in right now, there are a lot of entrepreneurs starting small businesses, seeking small business loans, whether those are SBA loans or whether those are just regular commercial business loans. Small businesses and the increase in that marketplace has also led to an increased demand for working capital, most notably, and then very often things like acquisition capital, acquisition of necessary assets, fixed assets that could be real estate, that could be equipment, it could be building up inventory. But small businesses have driven a lot of the C&I lending the last few years, particularly in the non-Big Four national bank group. The good thing is that demand is going to remain high as far as anybody can see. The challenge, as we'll talk about, is small businesses or startup businesses present different underwriting challenges. And we'll spend some time talking about underwriting and how tightening of underwriting qualifications and underwriting standards lead to different legal documentation needs, different demands on what your documentation system is. And when I use documentation system, let's break it really down into three groups. The first is just your old-fashioned lawyers doing commercial loans like I did for 25 plus years after I switched over from being a litigator. Big part of my practice was always in commercial lending, and that I could see in 2015, 2016, that it was becoming much more difficult to do the types of volumes that my clients were demanding that we meet, and doing it at the speed and at the complexity that was scalable for particularly national lenders, but any type of high volume commercial lender. So you have your lawyer driven document. Then you have what is referred to as first generation automation platforms. And those first generations can be commercial products that many of you are familiar with. They can be in-house products that a lot of lenders have developed to be able to handle the documentation in-house, whether it's by a closing department with the assistance of in-house counsel or through the in-house counsel office. Those homegrown in-house products are the second option. And then finally, you come to, there are a couple of large players, Laser Pro being one of them, that has provided commercial finance documents for many, many years and has successfully been able to document billions and billions in loans. But the platform is limited. The platform's not necessarily agile or flexible. And in a market like this that is changing so dynamically, both because of economic factors, because of the change overall in the way this country does its business and the way that it finances its business, the need to be able to have documents that can have complexities, that can have nuances, that can give a lender greater control of both monitoring the business of their borrowers, monitoring the status of their collateral, being able to have different triggers that give the lender greater rights to protect their interests, to both see the credit facility go to maturity and be paid off in a non-disruptive manner, both to the lender and to the borrower, but at the same time, address risk and manage risk. The first generation document platforms really don't provide a lot of answers in that way. So where do people turn? Well, maybe they start off with first gen systems or in-house systems, and then they need to turn to the lawyers to add the more subtle complexities into the documents. This is particularly true when we start talking about specialty and niche businesses, medical and dental practices. The demand for commercial loans in those industries is at an all-time high right now. And these are interesting industries to work with because you see a lot of entrepreneurs, you see a lot of individuals that maybe present a diverse collateral mix that could serve as collateral for a commercial loan, everything from the real estate that they may own and occupy to complicated, valuable equipment they use as part of their practices, to inventory and receivables. And so there's a whole industry that is being generated right now nationwide to try to address the demand from medical and dental professionals for commercial financing. Law firms and accounting firms, they're interesting because of, particularly law firms, because of certain ethical and organizational rules. Law firms are very limited in the types of entities that they can be. So traditionally, they've been partnerships, and many of them have moved to limited liability partnerships, but they still function, as do accounting firms, as partnerships. And because of that, they have a very interesting cash flow situation where cash flow is very tight, usually the first 6 months of the year, because all the books are zeroed out on December 31 of the prior year. And so building up the work in progress, building up receivables, collecting on those receivables, it usually takes law firms 3 to 6 months to really start realizing on their pipeline of work that they have out there from the prior year and into the new year. So they are relatively cash poor at the beginning of the year, relatively cash flush towards the end of the year. And then, of course, they clean the books on December 31. So there are huge cash flow balancing needs. And because of the way law firms and accounting firms are managed, financial covenant and cash management controls are particularly important. Things like deposit account and control agreements, lockbox agreements are standard in any type of commercial lending to law firms and accounting firms. Small manufacturing firms, this is one of the areas that is predicted by both the Fed and by other commentators as being a large growth area that is strong right now and will continue to remain strong over the next few years. These small manufacturing firms are fragile in some ways, and even though the demand for their services is high, they run at very competitive margins right now. So there's not a lot of fat on the bone, as it were, and the need, again, to have sufficient financial covenants to not only understand the current situation of these businesses, but be able to do a little bit of forecasting as to where the business is going to be in the next 6 or 12 months during the life of a working capital loan, let's say, and being able to stay on top of that, being able to have tools within your loan documents that for a lender give you more control over how monies are dispersed in a line of credit or revolving line of credit, and how those monies are paid back. Do you have the ability as a lender, for example, to roll from an interest-only structure to a term-out structure, where maybe you impose disbursement controls and you start to amortize the repayment of the loan over a fixed period of time? Very important in the manufacturing area. And finally, with, I think it's 37 states now who have legalized cannabis in one way, shape, or form, cannabis businesses it's a large industry, but it's still a very confused industry because you have the tension between state law that has legalized it in many different states, in many different controlled forms, and then, of course, the federal law, which still regulates cannabis as a Schedule I drug. And so, although there have been some strides made to try to harmonize that imbalance in the law, because a legislative resolution is not really expected in the foreseeable future, loaning to cannabis businesses have all kinds of different unique pitfalls. One of them being probably not the type of inventory that you would take a collateral interest in as a lender. And finally, supply chain challenges. And supply chain challenges in particular are very disruptive right now. And although I've been reading how supply chain issues are smoothing out somewhat, they are not going away, and nor are they forecast to be going away in the near future. All products are now, and all businesses are somewhat tied to a global network, or at least are responsive to global pressures. And that is our future, and that puts an incredible demand, particularly on larger manufacturers, on large retailers, to be able to manage that supply chain issue and be able to deal with some of the political problems when you're dealing on a global basis. So we're going to spend a little time on each of those areas. Moving forward here, so today's market, ever-widening landscape of borrowers. We've talked about that a little bit. Each of the different types of borrowers require more nuances than simply a note that has a promise to pay and repayment terms, maybe a security agreement that takes a security interest in collateral, and then eventually maybe a loan agreement that has some basic terms of the relationship. Really what's needed, particularly when you're lending to startups or small businesses that have very volatile business cycles or very uncertain business cycles, is to be able to, as a lender, provide the capital, but mitigate that risk. So let's talk a little bit about underwriting. As many of you know, when you go through tough times, you'll see people say, well, underwriting requirements are tightening up, or underwriting standards are getting more tight. Well, what does that mean really in the practical world? Well, one of the things is you see shorter tenures on loans. You don't necessarily see 5-year working capital lines. Maybe you see a 12-month or a 24-month working capital line that can be renewed, or perhaps have a rate reset before renewal, or perhaps have additional financial covenants be triggered as part of a renewal or an extension of the tenor of that loan. Having the flexibility to add those pieces in at the outset of the deal, or in the middle of the deal as the lender and the borrower try to continue to work together and reshape what the relationship is going to be, flexibility is certainly a huge pressure. Disbursement controls. If you're a lender making a line of credit loan, perhaps an equipment line of credit, or perhaps a working capital line of credit, or even a revolving line of credit, and this could include both non-borrowing based type facilities or borrowing based type facilities, having control over disbursements, having early warning triggers when borrowers are doing their proper financial reporting, they have their proper financial covenants, and maybe they trip one of those items. What type of disbursement controls does the lender have? What type of ability does the lender have to be able to maybe impose additional requirements for disbursements going forward in those types of situations? That's the type of nuanced complexity that a lender in this market really benefits from, because the ability to be able to say to a regulator, we understand the risk, we are addressing the risk, and we have tools that allow us to do that, and how our money leaves and how our money gets returned back to us, it is just absolutely critical. Likewise, loan balancing. Advance rates right now on different types of collateral are one of the areas where you'll see a lot of competition between lenders. You know, with rates being where they are, margins are very tight. And so there's not a huge amount of competition on rates necessarily that we're seeing, but certainly on advance rates within a facility. So is a lender going to advance 65% advance rate on inventory, or maybe 70% advance rate on equipment? Being able to have those advance rates. And then again, if something changes to the negative, if you have a material adverse change for your borrower, as a lender, you don't want that to kick you into a default scenario, maybe prematurely. But you do want those types of material changes in either the overall market or more specifically with the borrower and its industry to be able to have more controls, reduce those advance rates, be able to dial back the disbursement of funds and rebalance the loan if necessary by requiring a principal pay down in order to balance the loan. Like I mentioned, the ability to do shorter term loans and reset the rates before renewal or extension. Financial reporting and financial monitoring. This is an area where you're going to see a huge benefit from technology, because as there are demands on lenders to monitor their borrower's business more closely and more regularly, to monitor the collateral with great specificity, that's going to require technology. Technology not just in creating the documents, but technology in servicing those loans that have been documented. And this is one of the areas where I think you're going to see a lot of fintech answers for lenders being created. They're being created right now as part of several different servicing programs, and large servicing companies are getting more sophisticated in what they can offer in terms of the types of technology that can be employed, again, to monitor compliance with disbursement controls, but also to monitor compliance with financial reporting, collateral monitoring, and financial covenant compliance issues.
By the way, let me just inject. If anybody has any questions, please put them in on the Q&A button at the bottom of your screen. And at the end of the webinar, we'll have some time to answer those questions. Thanks, Ren. I didn't mean to interrupt you, but thank you.
No, absolutely. Thanks, Steve. So as a note here on the slide, flexibility and agility in your documentation, in your servicing are just so very, very important. We talked a little bit, and I want to leave some time for us to have questions here at the end. We talked a little bit about the challenges of medical and dental practices. The loan structures are a little bit more unique. They're very financial covenant driven. They're often, there can be a mix of collateral. You can take real estate as an abundance of caution, because many doctor groups or dental groups own the building that they're in. They may own a surgery center part that's connected to the office building. And so there's a potential to mix real estate with personal property collateral assets. Some of the challenges, how are those documented? How do you preserve your real estate remedies as well as your personal property remedies and not have those be at odds with each other? Requires more complex legal drafting. As I mentioned, with law and accounting firms, financial covenants and cash management, lockbox scenarios, having the ability to have a springing lockbox or a soft lockbox that moves to a hard lockbox. Those types of controls are essential to this type of lending. Again, with small manufacturing firms, you'll see a mixed collateral package, much as I mentioned with medical and dental. That creates lien perfection, lien enforcement issues when you're mixing real estate collateral with personal property collateral. And then we touched a little bit on the cannabis businesses and the unique collateral difficulties and the unique banking difficulties that these businesses pose. Finally, in the supply chain area, it's bad enough that the retail industry is really being shaken to its foundation with online business, with internet sales, but supply chain is also just disrupting retail businesses with the amount of products they can keep on the shelf and the type and variety of products. Same with, interestingly enough, residential and commercial real estate developers and contractors. The cost of constructing different use properties has skyrocketed since the pandemic, largely due to the increased cost in basic construction materials. And there's really not a light at the end of the tunnel right now for that. Those materials are scarce, they will remain scarce. And so taking your collateral interest in the business assets of these types of borrowers is important. Inventory warehouse distribution centers. Anybody who's driven anywhere across country sees these huge distribution centers for everybody from Amazon to Target to Walmart. That just sometimes it's miles and miles you'll see on the open road. These warehouses obviously only function if they are quick turnaround time because of an abundance or access to inventory, and supply chain issues can really impact you in that way. All of these then really lead us back to where we started, which is, what are your solutions right now? Well, there's the legacy or the first gen software, there's using attorneys, and then there's a hybrid. And what we found in surveying the industry is that about 70% of commercial lenders use some type of automated legacy system, whether that's in-house or an outside product. About 20% of the overall portfolios are hybrids, where the legacy automated product is used and then supplemented by attorney work. And then there are still just transactions that are purely attorney driven. Now, if you've got a 10-bank consortium that's making a $500 million borrowing base credit to a national manufacturing firm, for example, that's probably going to remain an attorney product. But the bread and butter of commercial loans is becoming more complex, more diverse, more challenging. And there's no reason that a lender should have to settle for either the constraints of legacy first-gen software or the constraints, both cost, speed, and scalability of going straight to attorneys. But you really do need a solution that can tackle all of those in terms of providing the attorney sophistication with the ease of automated, immediate documentation. And that's really where the C&I product that we have developed has come in and been able to provide the type of different types of collateral, where you can have, for example, a borrowing base with different advance rates, different collateral monitoring for different types of collateral, be it inventory or receivables or equipment, having a multitude of available financial covenants, anything from EBITDA to capitalization ratios to a current ratio to a fixed coverage charge to just a DSCR test, as well as the importance of having guarantor monitoring, having net worth and liquidity requirements, monitoring those, having triggers in your loan documents if those covenants are not met, and how to realize on your collateral or take control of the disbursement and repayment terms. A variety of guarantees. Again, there can be value guarantees, loan to value guarantees. There can be sliding and springing guarantees, as well as the cash management type of documentation. Being able to automate that and have somebody sit down and create a package with all of those moving pieces and then generate the documents in 60 seconds was unthinkable as recently as 3 years ago, but it's a reality today, and tomorrow it's going to be a necessity. And so we need to start, the entire industry needs to start understanding that what is maybe a luxury today is going to be a requirement to have the type of business and the strength of portfolio that you're looking to have. From the dashboard, you can see we have a lot of tools available, similar to those items that we discussed during the webinar. For example, if a lender wants to create a pledge of ownership interest in the borrower, they can do that straight from the loan party page. Identify individuals who will pledge, whether those pledge certificates are going to be properly certificated, or evidenced some other manner, and even add additional pledge parties in order to make sure that 100% pledge is obtained. Likewise, creating financial covenants is very easy. On the loan page, the user simply identifies if they're going to create covenants. That will take them to the financial covenant page. As you can see, there are a variety of covenants, including operational covenants, liquidity net worth covenants, tangible equity, funded indebtedness to EBITDA, and other ratios to monitor the health and the well-being financially of the company. In addition, building complex collateral packages is easy from the C&IDocs site. For example, the creation of a deposit account and security agreement starts off with a simple click of a yes button, and additional information will be created. Identifying if you want an all business assets collateral general security agreement, again, as a click of a button. You can add different collateral types. You can identify what the advance rates will be for those collateral types. You can also get specific for things like titled equipment, specific equipment. In addition, you can add multiple collateral types to a single facility and also have additional advance rates. Finally, you can easily toggle back and forth between different types of credit facilities. A simple term loan, like for an equipment financing, a line of credit, or even a revolving line of credit. The system will know to ask you, is this going to be a borrowing base line of credit or not? If there is, you can have a global advance rate, or again, as was shown on the collateral page, individual collateral type advanced rates. Finally, if you do have a revolving line of credit, you're able to identify minimum advance amounts, required additional incremental advance amounts. You can add clean down periods, simple clean down periods for a 30-day duration, or more complex and flexible clean down periods. The options are numerous, but all of these go to giving the lender greater control over disbursements, greater insights as to the financial health of the borrower and or guarantor parties, and provide safeguards that allow a lender to be able to confidently make commercial and industrial loans, even in a tough economic environment. So with that, Steve, I'll turn it back to you for the Q&A.
Yeah, good, thank you. You know, I do want to just comment on the slide just before this, because just before that, it reminds me where commercial real estate loan documentation was, a few years ago, let's say. It certainly remains today in a lot of our customers as we bring on new customers. And the idea that, in fact, I think LaserPro in particular, we found most lenders would sort of use LaserPro for loan values of 2 million and under. And it was primarily because those were more simpler loans, typically pretty much down the fairway, and the banks felt comfortable using an automated solution for that. And then, of course, there were other loans where there might be some kind of vesting or multiple collateral, multiple borrowers that required a hybrid model where the LaserPro platform might take you part way, and then the rest of the way is done by attorneys. And then finally, there is this category of things which are just kind of so complicated, that a tool like LaserPro sort of just was not even approached and used at all. And as you all know on this call, we really kind of changed the game in terms of commercial real estate loan documentation, so that for the most part, and I think everybody on this call, I look at the names of the companies on this call, and I see that most of you are in our full automation mode, meaning that every loan you do with us in commercial real estate is fully automated, whether there's cross collateral, whether there's multiple borrowers, multiple collateral, non-standard vesting, loans to 50 million, it almost doesn't matter. You just use us automatically. And so the return on investment is dramatically different from if you have a solution like this on a slide where the lawyers are involved and you've got a slower response time and a higher cost that you pass on to borrowers versus if you're fully automated. And so I think ultimately, I think everybody on this call will agree, we're all about delivering the best customer experience, because the way you get customers coming back, you give them the best experience. So the best possible experience is full automation, a digital flow, which gets you the fastest documentation, and so that you can compete better against others that are trying to get that same loan documentation out. So anyway, I just wanted to, just struck me when I looked at this and I saw, gee, this is where CRE was. And now with next generation GoDocs CRE, this is 100% automation. That's kind of what we're trying to do, and we have done, I think, with our C&IDocs. So again, as I said at the outset, if you love what we're doing in CRE, I think you're going to love this even more. And I'll just say this, since you're already on our CRE, imagine the benefits of consolidating all of your loans on one platform, a GoDocs platform, your commercial real estate and your C&I, one platform, one user interface, one vendor, one support organization. I think there's a lot of benefit and return on investment for that approach. Anyway, didn't mean it to be a bit of a monologue, but it ended up being so. Let me get to some questions, because there were some questions that came in, and I want to just kind of, Ren, if we can get to some of these, it'd be great. Some of them are a little complicated. Let's see. The first one is, with your C&IDocs platform, are there unique risks when a C&I lender takes a lien on company-owned real estate as an abundance of caution to support a traditional C&I loan? I hope you understand what I was just saying.
Yeah.
So, okay.
Yeah.
All right.
Yeah, no, that makes perfect sense. And yeah, very often, and I've seen this for the last 20 plus years, and we'll see it into the future. And I'm talking to lenders now who need a little bit of extra shoring up under their underwriting standards to perhaps make a working capital line of credit or revolving capital line available. So they will take a lien on real estate, and they'll call that abundance of caution lien. And I think the inference internally within lenders is that, oh, well, this is kind of a last backstop piece of collateral. But what every lender needs to realize is, whereas the Uniform Commercial Code, which is pretty much standardized in all 50 states, there are some slight differences from state to state, but they're minimal. And our compliance program makes sure that we address the rights and remedies and notices and lien perfection issues that might be slightly different in a few states compared to the general UCC. Real estate lending law is very different from state to state. Whether you use a mortgage or a deed of trust, or what lien, how you foreclose on the lien, and what rights you have to the property. And so the reality is that even though you may be taking an abundance of caution deed of trust or mortgage, in a way you're making a commercial loan that is a commercial real estate loan, because you'll have to attend as a lender, and your documents will have to make sure to clearly distinguish between your real estate remedies and your UCC remedies, your notices for real estate versus your notices to take control of personal property collateral. And distinguishing between those two can keep a lender out of any conflict in remedies issues, conflict of law issues, and allow them to realize or control their collateral package effectively and have that abundance of caution without derailing the project because of either lack of sufficient safeguards in the documents or an understanding of how to take advantage of those safeguards.
The question that, so I'm going to give you a follow-up, even though it wasn't asked by the questionnaire, is that, are we doing something in our documents that does create that separation, so the lender does know what the remedies are? They're fairly well understood and demarcated?
Yes, yes. So for example, the overall Bible of every transaction is your loan agreement. And if you do have that mixed collateral package, the C&IDocs loan agreement is going to be very specific on real property remedies versus personal property remedies. It's going to explain how those are exercised. It's going to treat these liens in the appropriate separate manners. Your deed of trust will be integrated with your security agreement, but they will be separate instruments that have their own rules and nuances that allow the lender to have those controls that they want. We jokingly call it C&I light because it does combine the real estate aspect, which changes the overall nature of the loan, but you're able to preserve the best and the most dynamic features of both loans when you create a combined package in C&IDocs.
Okay. Next question. Do you cover all types of collateral? And if there's collateral you don't have, what is it and where will it be available?
Good question. So right now we're covering all of the most common collateral packages. That's inventory, equipment, accounts, receivables, titled vehicles, manufactured housing, pledges of ownership interest in the entities, again, cash collateral through a cash management structure. What we don't have right now is we do not have any purely agricultural product items. So crop financing, or let's say for fishermen, catch their boat financing and catch financing. We are not yet doing those. Our roadmap is to continue to expand our products throughout 2023 into 2024. But it will probably be 2 quarters before we really start to do that type of lending within our platform. So those would be the 2 gaps that I would point out that are probably the most salient.
Yeah, okay, that's fine. Yeah, we've got a good number of banks using the product, and I have not seen call for agricultural, but I suppose it's possible in different parts of the country. So that sounds great. Another question is there a title insurance product to protect a lender with respect to C&I personal property secured loan?
Yes, there is. And not too many people either are familiar with this or take advantage of it, but title companies, much like they do for a real estate secured loan and providing a title policy of insurance, you can get a similar type product for personal property collateral. Now, there's some types of collateral where that type of protection is maybe less relevant than others, but certainly if you're doing things like equipment financing, inventory financing, if you're going to be doing any type of receivables financing, being able to have an insurance policy that guarantees the perfection of the lien, the priority of the lien that you have, and the availability of remedies under that lien. There absolutely is a product, and I know towards the end of my years at Bryan Cave, we more and more would discuss the reasons for having that protection with our lenders in C&I loan products, and started to use them on a pretty regular basis. And one of the things that we've created here at C&IDocs is we are creating this LegalNet ecosphere, and it's both a network of attorneys who work and support our product when, let's say, there are negotiation issues that come up. But we're also building that network with the title companies too, and making it available for a lender to order title protection, a title policy directly from the platform. And I think lenders should be well aware, and we're happy to have chats with people on this call individually to help them understand a little bit better about what the title products are, how much they cover, and what are the advantages to using them or maybe not using them in certain circumstances.
Great, thanks, Brent. Another question, the host, well, I guess that's B, implied that you guys can do the hard stuff, and that the Finastra product, for example, can't do. Can you give a few examples of hard stuff you think that you can do with your C&IDocs?
Yeah, I think, Steve, some of the things that I talked about near the end, and let me back up here, when we're talking about the multitude of financial covenants for businesses, borrowers, the number of covenants that we have coded, the flexibility in how those covenants are monitored, the result if a covenant is tripped, what additional rights and remedies that afford the lender. That would be an area there. Complexity of guarantees, our ability to produce a wide variety of guarantees that aren't just simple full repayment guarantee, but perhaps have different triggers as to when the guaranteed liabilities arise and then how they're recovered upon. Certainly cash management tools, the different types of lock boxes that we talked about. There are a lot of moving parts to make that work. The advantage for banks in this area is they're able to have control of the accounts because they open the account at their institution. But there are still various different bells and whistles that have to be attended to have a fully functioning and really manageable cash management tool and different types of lock boxes. That would be an example. Another example is that combined mixed collateral situation that we talked about with real estate and personal property collateral. And maybe the last one that I would mention is complex ownership structures. If you're making a loan to a variety of companies that have different assets that are going into a collateral bucket, let's say for a borrowing base facility, you may have a family of companies with a distribution piece and an inventory piece and a production piece. Being able to have a multitude of borrowers with different financial covenants, different collateral tests, different collateral ownership, that is an area where, again, you're getting into very complex deals, but we've automated those deals. And that's not something you'll find with first-gen software.
Great. Last question that came in is, if I wanted to try a product out, get a demo, what's the right way to sort of kind of move forward? Do I reach out to the operations group that I work with, the doc prep team, or do I have a different process? We want to see a demo of this.
Well, I think obviously our rapid response team is led in operations by James Martin. And I think everybody on this call is probably well familiar with James and his ability to make things happen very quickly. And that includes being able to set up a demo with me and others in the company to walk through how our program works, how the platform functions. Of course, Steve, I'm sure you won't have a problem with me volunteering both of us. Anybody can reach out to either of us, and we have a real passion for this product, and we have a real passion for this expansion of our platform. So certainly, you can go straight to either of the two of us. But if you've got a great working relationship with James, that would be a great first place to start.
Well, is it okay if I counter what you said? I do think for C&IDocs, reach out to Ren, myself, or go through our website and request a demo that way. Either one of those mechanisms, I think, will keep James focused on supporting this great group of lenders, for example, we have on the call, and so many others. But let's you and I take this on, and we want to work very specifically, especially with our key customers like are on this call, and give them the best possible C&I demo and question, custom question and answers. So
absolutely,
let's take that approach. Yeah, great. Okay, I think we're running. I have no more questions. So if there's any last minute questions, please don't hesitate to send them in. But I guess since we're done with questions, let me just thank everybody for their attendance. Everybody stayed right to the wire. That's great. We only had maybe a few people drop, and that's fine. really excited to share this information with you. Look forward to engaging with some of you and taking a deeper look at C&I. I hope you do that because I think it's going to be something that will serve you really well, just like our CRE products have for so many years. So with that, I think we can end the webinar. Again, thanks all and have a great rest of your day. Bye
Thanks,
now.
everybody.